January 19th, 2010. If you were standing on the observation deck at Narita Airport, tracking a massive Japan Airlines Boeing 747 taxiing down the runway, you were essentially looking at a ghost. Behind that iconic red crane logo, the company was suffocating under $25 billion in debt. It was the largest corporate failure in modern Japanese history. In the brutal, unforgiving math of commercial aviation, when an airline fails that spectacularly, they don't usually bounce back. They get chopped up and sold for scrap. But if you point your lens at that exact same runway today, you won't see a bloated, dying relic. You'll see a financial fortress. We're taught that the only way to survive the razor-thin margins of the airline industry is pure, unregulated scale. You have to buy hundreds of metal tubes, fill them with volatile jet fuel, take on a mountain of corporate debt, and aggressively swallow your competitors. The industry is obsessed with getting as massive as physically possible. Japan Airlines did the exact opposite. They looked at their $25 billion collapse, and they shrank. Today, we're breaking down the $11 billion macroeconomic resurrection of JAL. We're going to look at how they mastered the absolute art of right-sizing, weaponized a highly disciplined 227 plane fleet, and built a zero net debt balance sheet that makes their regional rivals look dangerously fragile. Aviation is a notoriously brutal industry. Companies are required to purchase metal assets that cost hundreds of millions of dollars, fill them with volatile jet fuel, and hurl them through the upper atmosphere at 80% the speed of sound. They do all of this in the hope of capturing a profit margin so razor-thin that a slight macroeconomic breeze can bankrupt them. Because of these brutal economics, the industry is obsessed with scale. Airlines try to outgrow one another, believing that if they just get big enough, they'll finally become untouchable. But if you want to understand what true, sustainable scale actually looks like in modern commercial aviation, you can't look at the legacy carriers of North America. You have to look east. You have to look at Japan Airlines. Today, JAL is a corporate leviathan commanding an $11 billion annual revenue stream. It operates an optimized fleet of over 220 mainline aircraft, battling daily in the world's third largest economy. But unlike the legacy carriers of North America or Europe, which often operate as debt-fueled empires, Japan Airlines is a highly disciplined giant. But to truly understand this modern machine, you have to look at its scar tissue. The current iteration of Japan Airlines was built directly on the ashes of one of the most catastrophic financial failures in corporate history. In January 2010, the airline filed for bankruptcy protection. It was suffocating under 2.3 trillion yen in debt, roughly $25 billion. It marked the largest bankruptcy of a non-financial institution in Japan since World War II, resulting in the airline being swiftly delisted from the Tokyo Stock Exchange. Fast forward to today, and the transformation is staggering. JAL has been entirely reconstructed into a high-margin, financially conservative powerhouse. By the fiscal year ending in March 2024, Japan Airlines reported a consolidated revenue of 1.65 trillion yen. That is $11 billion flowing directly through the company's coffers in a single 12-month period. This upward trajectory continued into the 2025 fiscal year, with revenue expanding to 1.84 trillion yen and net profit climbing to 107 billion yen. Let's physically contextualize that scale. To move $11 billion a year means that every single day, roughly $30 million in cash is actively changing hands within the JAL network. It's an economic footprint that eclipses the GDP of several small nations. But how do you manage that much cash without collapsing under your own bureaucratic weight? The answer is a radical organizational structure, known as Amoeba management. Implemented during the airline's rebirth by executive Kazuo Inamori, this philosophy decentralized corporate control by dividing the airline into small, independent units, the Amoebas. Each unit tracks its own real-time expenditures and earnings. By distributing the financial responsibility down to the micro level, JAL achieved something incredibly rare in commercial aviation. It became massive without becoming slow. But to move $11 billion, you need the right metal. In aviation, capacity management is high-stakes chess. The historical trauma of relying on inefficient Boeing 747s taught JAL a harsh lesson. Fleet size must be strictly calibrated to actual demand. As of early 2026, JAL commands an operating fleet of approximately 227 aircraft. For dense domestic routes connecting Tokyo to cities like Osaka and Sapporo, JAL is actively retiring its aging Boeing 767s and 737s. To replace them, they placed firm orders for 38 next-generation Boeing 737 MAX 8s and, in a historic pivot away from an all-Boeing narrow-body fleet, 11 Airbus A321neos. This dual-supplier approach guarantees domestic network resilience while cutting CO2 emissions by up to 25%. For international routes, JAL leans heavily on the Boeing 787 Dreamliner, operating over 45 Dreamliners, with 10 more on the way. The lightweight composite airframe allows JAL to bypass traditional hub-and-spoke limitations and fly thin, point-to-point routes across the Pacific with ruthless economic efficiency. Finally, at the top of the hierarchy sits the new international flagship, the Airbus A350-1000. Ordered to achieve a 1-to-1 replacement of its retiring Boeing 777-300ERs by 2028, the A350-1000 represents JAL's aggressive push into the ultra-premium market. With first-class suites featuring sliding privacy doors and massive beds, JAL uses the physical hardware to justify a premium pricing structure, prioritizing high profit margins per passenger over sheer volume. The operational achievements of the JAL fleet are underwritten by one crucial factor: the raw strength of its balance sheet. The airline industry is notoriously capital-intensive. Procuring aircraft and purchasing volatile jet fuel requires immense continuous liquidity. Historically, airlines manage this by utilizing dangerously high levels of debt. This creates a fragile ecosystem where a pandemic or an oil shock can instantly trigger default. Most airlines are essentially debt repayment machines that happen to fly planes, but Japan Airlines emerged from its 2010 restructuring with a mandate to avoid over-leveraging. For the fiscal year ending March 2025, JAL reported an equity ratio of 41.1%. In corporate finance, maintaining an equity ratio over 40% in aviation is highly anomalous. It means nearly half of the airline's assets are financed by solid shareholder equity, not crippling debt. Furthermore, JAL achieved a net debt-to-equity ratio of strictly negative 0.0x. They possess enough raw cash to completely liquidate all their interest-bearing debt simultaneously. To guard against sudden macroeconomic shocks, JAL maintains massive liquidity on hand, roughly 5 to 5.6 months' worth of passenger revenue. This financial armor allows JAL to operate offensively while remaining defensively secure. For JAL, being big isn't the goal. Being unkillable is. To truly gauge the magnitude of Japan Airlines, you must contextualize it against its primary competitors. To understand JAL's gravity, look at its arch rival, All Nippon Airways, ANA. By almost every metric, ANA is larger. By late 2025, ANA reported trailing 12-month revenues of $15.7 billion. It operates a larger fleet of over 240 mainline aircraft and completely dominates the lucrative Trans-Pacific corridor. Financial markets value ANA higher, awarding it a market capitalization of approximately $8.45 billion compared to JAL's $7.04 billion valuation. However, JAL's strategy diverges significantly from ANA's volume-heavy approach. While ANA targets raw market share and multi-brand segmentation, operating both mainline and low-cost subsidiaries like Peach, JAL is highly focused on premium yield optimization. JAL uses its 33% share of the domestic market to feed highly lucrative passengers directly onto its premium international routes. The low-cost carrier strategies highlight these operational differences. ANA attempted to launch Air Japan as a low-cost carrier, but abruptly shuttered the brand by March 2026 due to supply chain issues. Conversely, JAL's medium to long-haul subsidiary, Zip Air, found massive success, expanding rapidly across the Pacific utilizing a highly efficient fleet of Boeing 787s. When comparing this Japanese duopoly to regional titans like Singapore Airlines, the geographical hub strategy becomes evident. Because the island city-state of Singapore lacks a domestic market, SIA acts entirely as a global transit connector, exposing it heavily to the volatility of international border policies. Conversely, JAL and ANA benefit from the demographic buffer of Japan's 125 million citizens. The robust domestic market provides a stable, predictable revenue floor. As JAL plots its trajectory toward 2030, its expansion remains guided by surgical precision. By 2030, JAL anticipates expanding its international network by 1.5 times compared to its 2023 baseline. Domestically, JAL is launching a comprehensive service renewal in April 2026 under the concept New Angles, New Stories, and plans to expand domestic first-class routes nationwide alongside the new 737 MAX 8 fleet. But the most critical element of JAL's future is the global energy transition. To survive the intense regulatory pressure to decarbonize, JAL emerged as an aggressive proponent of sustainable aviation fuel, or SAF. Their target's to replace 10% of total fuel usage with SAF by 2030. The barrier to SAF is its high cost and a lack of global supply. Rather than waiting for the market to fix the bottleneck, JAL is proactively engineering a domestic supply chain. Through the Act for Sky Alliance, strategically partnering with their arch-rival, ANA, and the Mori Sora project with Airbus and Sumitomo, JAL is actively producing SAF from domestic wood biomass and municipal waste. So, exactly how big is Japan Airlines? Evaluating the company solely through physical mass is a fundamental miscalculation. Yes, it is an $11 billion enterprise with 227 aircraft, but its true scale is measured by institutional discipline. The catastrophic 2010 bankruptcy taught JAL that unregulated, debt-fueled growth is an existential threat. By integrating Amoeba management, right-sizing the fleet, and forging a zero-net debt balance sheet, JAL perfectly insulated itself against the macroeconomic shocks that routinely decimate its competitors. Japan Airlines proved that you don't need to be the biggest airline in the sky. You just need to be the most disciplined giant on the tarmac.